of Q star times Q star. And I do not know how to use this program well enough to get multiple colors, but let's go a different angle. This box here that I'm shading in now is the total cost. The total cost is this bottom box. The total revenue was going all the way up to here. And then we have total revenue minus total cost, which will be our profit. And there's a rectangle here at the top. That revenue was greater than costs. We like it when revenue is greater than cost, and we have a box up here. That's our profit box. I don't know if I can change my marker. No, it's all right. I'm gonna have to keep practicing. I can't figure out how to change the marker color. We're stuck with red. All right, so this is our graphs of profit. So, and we know, just again, by definition, this point is the point where this profit box is biggest. If we set quantity any less, we wouldn't be getting as big of a profit box as we could. If we set quantity more, our costs would start going up, and the shape of the box would get smaller. So the biggest box that we can get here is at this point where price equals marginal cost. That's sort of like by definition. Here's the pretty graphs that I put in here so that not everything looks like fuzzy. Sorry, I'm a little off. OK, so we have this question. What happens if the price, the market price, is less than the average cost? What do? We have our internal structure of our firm, and we have the price coming from the market, and we're like, what do we do when the price that we can get for units of output is less than the average cost? So here we get profit would be negative, right? So our total revenue here would be less than our cost to produce it. Total costs are greater than total revenue, so we get a negative number. So we choose to go all the way to 0. And our profit actually ends up being the negative of fixed costs. Fixed costs are money we have to spend whether we produce 0 or 10 million units. So when we go to 0, we just have to swallow the fixed costs. So we're going to call this the shutdown point. One more time, I'm going to go back to this one. Average variable cost. Let's see, these two minimums become important again. So we're asking, what happens when the market price, here's the price here. So this price is the minimum of average cost. And this price here, go away, the minimum of average variable cost. So we have 2 points here. This point where marginal cost goes through the minimum of the average cost, this would be a Q where profits equal 0. Right? At this point, there would be 0 profits. It's a very important point. We'll talk about this a whole bunch more. This point, the other really important point, this minimum of average variable cost, is a quantity where we would stop operating and go to 0. We're going to call this the shutdown point. And this price, we're going to call the shutdown price. OK, so importantly, there's an area in here of the marginal cost curve where we would be operating at a loss. At this point, profit equal, up here, we have our profit box that we just graphed. Below this point, we have some sort of negative profits, but they're above average variable cost. So this is where we're operating. So let's put it over here. This is where we're operating at a loss. But importantly, we could still be paying back some of our fixed costs. Because we're higher, so we're higher than our variable costs, this is still an amount that we could pay back some of our fixed costs. Right? If we go to 0, we have minus fixed costs. At Q equals 0, we have minus fixed costs. But in here, at these Qs in here, we can get some returns above variable cost and pay back some of our fixed costs. Sorry, it's a little slippy. So for any price in here, we would keep the firm open, keep it running. This is the point that we pay all of our employees off. This is the point that we pay our employees and our machinery off. So here we've got all the employees paid, and in here we have some money coming in to pay off some share of the machinery. In the Swedish paper mill, this was the cost of the mill. This was the cost of the energy and the inputs and the pulp to run the mill. So up here we're profitable. Here we're not profitable, but we're still running the factory to pay off some of the fixed costs. So what we also get is from this point, the shutdown point and up, following the marginal cost curve, this whole thing we can put in bold. This is the firm supply curve. So this would be a supply curve because at any price along here, the firm would deliver some quantity. It starts right here because below this point, the firm doesn't deliver any quantity. At any price above the shutdown price, there's a quantity that the firm will supply to the market. So it's a supply curve for that company. Just talking through the shutdown point, it's the lowest price at which the firm will operate. It's the lowest price at which the firm will open for business. If price is equal, so here we should say a minimum here. Price is at the minimum of average variable cost. If price is less than the minimum of average variable cost, you wouldn't operate. So where price equals the minimum, we know that marginal cost by definition crosses average variable cost at the minimum. So it's also the point where marginal cost equals average variable cost. That's another definition of the shutdown point. The 0 profit point is where marginal cost equals the average cost, or the average total costs. And we'll talk about that a whole bunch more. So here's our shutdown point, supply curve for this firm. All right, so here we have to introduce a concept that is economic profit versus accounting profit. So accounting profit is doing the books for the firm. Economists do it slightly differently, where they want to include the returns to capital. include the cost of the capital. The cost of paying the shareholders have invested in the company, you have to make a payment out to the shareholders, or the value of their stocks goes up. But those people are still holding that, and so we're going to value that. Importantly, we're going to think about it as the opportunity cost of the capital. So somebody's invested money in it, and that profit's going to be redistributed to the capital that's invested in it. So in accounting, if you pay out some of the profits, this would be a payment to shareholders, but it's also the payment who are holding the capital for the company, who have invested in the company. Now we think a lot about entrepreneurs and startups, right? And so we want to make sure that we have the opportunity cost of that time for the entrepreneur. So a lot of startups is like work crazy hard for no money in the hopes that eventually there'll be a big return and you'll get bought out. This is the mythology that we talk about a lot in the Bay Area. You know, work as an entrepreneur, start a new company, work really hard so that later there will be a return. So you're putting your time in as capital, but when we divide up later the cost of the firm and the entrepreneur gets a whole bunch out of it, they're getting paid back for like their investment of time and hard work in the beginning. So a lot of times profit is what goes to the entrepreneur. You know, the guy who owns the restaurant gets like what's left at the end of the day after paying all the costs. We need to value that in the economics. And I'm going to state this. A lot of things in this class I'll sort of state, and if you get into like Econ 100 or the higher classes, you can work on mathematically deriving this or taking apart or looking at it. But we would say in the long run, we're going to say that economic profits are going to go to zero. And we'll talk about this a bunch today. In a market with perfect competition and free entry over the long term, those are three big assumptions, economic profits are going to go to zero. So capital will flow in. If there is a sector, if there is a firm that's earning money, capital will go into that area. That will expand. Capital will flow to where it can find returns. So, and importantly, capital invested has an opportunity cost too. So capital will flow into where it's earning more returns than when it could make money elsewhere. So if there's a return that's greater than what the rest of the market is going, people invest in that sector. Investing in that sector will expand things and will drive profit down. So if there are profits, capital comes into the sector. We could either say new companies start, existing companies add to production, and supply is going to increase and reduce the profits for the existing firms. So we can walk through that graphically. We'll think about how we get from that firm supply curve that we just saw on the graph to a market supply curve. In the short run, each company has fixed capital, and the number of firms in there is fixed. So both of those are assumptions of short run. The size of the factory is fixed. The number of firms in the market is fixed. In the long run, firms can adjust their fixed costs. They can add capital. And the number of firms in a market can change. New companies can enter a market. And so this is this long run question. If there's profit in an area, firms will enter. More firms will add to the supply. So if we just take this thing that's the firm supply curve, it was the marginal cost curve. It was also the firm supply curve. Right? So, and we have some sort of price that's coming. That's the supply curve for one firm. And there could be another firm. There could be another firm. So this is firm 2. There's a supply curve for firm 3. They're all going to take this market price. They're all going to pick a quantity. Quantity 1, quantity 2, quantity 3. So a whole bunch of different firms. In the first example case, we say there's a market with 4 identical firms. They're all taking the same market price. They're all going to produce at Q1. And they're all going to, their supply will be the combination of the supply of those 3 or 4 firms. Importantly, we could also say, relax this assumption, and they could have different marginal costs. So in this example that I'll draw, everybody's having the same marginal cost. But there could be a marginal cost curve up here, and there could be a marginal cost curve down there. They're each receiving, this is a little subgraph, they're each receiving a market price, one supplying a little bit and one supplying a lot. But in this case, we're going to say they're all going to have the same marginal cost. There's multiple firms supplying a market. Let's say in this case, there's 3 firms supplying a market. The market price, they each have their embedded cost curves underneath. The market price is going to set how much each firm is going to supply. So if we have quantity 1, quantity 2, quantity 3, we would have these summing up as a market quantity. And this is, again, this question of, like, we're going to sum out horizontally. So a market supply, here's a firm supply, and we'll have a market supply. So for any given price, each firm is going to set a quantity, and those prices are going to sum up horizontally. Quantity 1, quantity 2, quantity 3, all 3 of those would sum up to the market quantity. Oh, sorry, this should be on this line here. I just put that in the wrong place. Everybody's using the same price. The market is getting the same price. All the firms are getting the same price. So we could have on the same graph, we could have this little firm supply curve with a firm marginal cost, and we would have a market supply curve with a combination of all the different reactions of all the different firms to a set of prices. So this market supply curve now has a bunch of information in it. It's got the supply cost structure of each of the individual firms, the opportunity cost for those firms for doing other things, or for the opportunity cost of their variable inputs is all going to now get embedded in this market supply. So when we think about a price as information, the amount of information is going to add up, and the market supply curve is going to have more and more information in it. So we have this big market supply curve that's summing up all the individual supply curves. An industry supply curve. So we're going to go back to thinking about the short run versus the long run. In the short run, we can construct that there might be profit. And in the long run, we're going to drive profits to 0. So this is a very generalized case, but profits are positive in some sort of short run. Profits are going to go to 0 with free entry in the long run, in an economic sense. So let's do this thing where we have our average variable cost, our marginal cost, and then we have a supply. This is the market supply. So these are different. Let's say these are different amounts of quantity. This is the firm quantity, and this is the market quantity. So the scale of this bottom one. So let's say there's a demand curve. We talked a whole bunch about demand. There's a demand curve. That demand curve is setting a price. People are buying and selling in the marketplace. The consumers are showing up, and they're saying how much of this product they're wanting. Each firm is going to use the price signal that's coming from the market into their firm, how much they're P star for the firm. So this is going to be P star both for the firm and for the whole marketplace. So there's a demand. So now we have, in this price, we have a whole bunch of information from demand and a whole bunch of information from all of the different cost curves of the different companies. So embedded in our price is some willingness to pay from all these different consumers and a willingness to supply the good or cost to supply the good from all the different suppliers. So the price has a whole bunch of different information embedded in it about both the opportunity cost for consuming things and supplying things. So yeah, right. In the short run, in this graph, there's obviously this profit box here. We have some short-term profits. I'm going to go ahead and say the case, what we would say in the long term, the profits, more and more firms are going to jump in because they see these profits. Capital is going to be attracted. They're going to see a return there in the profit. And as more firms join, let's think about it two ways. One is more firms are going to join, or they could add more capital and more machinery and expand the scale of their production. But let's just say more firms join in. There's profits to be had here. And the supply curve will move out, right? As more firms, so this is supply 1, supply 2, supply is shifting out. I'm going to do this again another time. But the price at this point is going, the quantity is going to increase because there's a new firm supplying, there's a greater quantity, but the price is going to go down as supply shifts out. So P new. More production comes into play, supply curve shifts out, the demand curve is downward sloping, so we get a lower price at a higher quantity. So let's think about market entry. I already walked through most of this. We do the 3 firms, adding to 4 firms graph. With there's 3 firms, there's still some profit for each firm. Market supply and market demand are meeting above the minimum of average cost. If the 4th firm enters, price is going to go down, and the new market price is going to lead to the bottom of the average cost curve for all 4 firms, if they're identical firms. So we already did this one, but let's say there's a, we're going to get to this point. So we're going to have some demand, supply 2, supply 1. We're going to have a point where the firm was profiting, and we're going to get to this point where profits equal 0. So here's a P with profit. It's going to get people to enter the market, and we'll drive it to a point where profits equal 0. Long-term equilibrium, profits are driven out of the market. Okay, so let's sort of think about, let's sort of stop on graphs for a second. Think about markets. Like, where do we see markets? How do we visualize markets? Right, so we think about going to the super safe way, the Costco. There's every product imaginable. There's hundreds of checkout aisles. Everything's pretty much driven down. I like to go to the farmer's market. Anybody here go to the farmer's market? Go to the farmer's market. It's right near the BART station in downtown on Saturday afternoon. You're probably passing by there. It's really good to go to the farmer's market because everything at the farmer's market is produced within a couple hours of here. So say you go to the farmer's market like quarterly, like once every season, and you see what's in the farmer's market in January. You think like that's what we can, we're super lucky we live in California. We can grow like crazy amazing things here. There's no polar vortex. There's bounty. But it's, over time you can learn, there's 6 months of apples, there's 6 months of oranges, there's, lettuce goes around the year, but, bell peppers and eggplant, there's only 4 months of those. So going to the farmer's market, you can sort of learn more about a place, like what's possible, what can be there. It's also interesting, the way that fruits and vegetables are presented in Safeway is like there's one commodified, beautiful one. But you walk down through the farmer's market, and there could be the same variety of apple, the same orange, and some will be beautiful, and some will be big, and some will be small. And you can think about like what is the context of our food, what you could pay for the same strawberry or apple, different prices on different farms. Or you could be, in the good time of year, there might be 5 or 6 kinds of strawberries there. Whereas Safeway, they're going to have one variety of strawberries at Safeway, right? So you go to the farmer's market and get the different varieties of strawberries, decide which one you like. Interestingly, different ways to pick out prices for things. And sometimes the farmers, they're going and looking at everybody else's stands, and they're going to set their price. They know they come up that day in the middle of summer, they have a ton of strawberries to sell. But they're going to look at what the prices the other people are going to sell, and their prices are only going to be within a certain range of what the other prices are going to be. So we have different ways to visualize markets, like that we consume in, but our society is now sort of constructed around markets. We have these visuals of a market, like we see the picture of a market. Most of this is conducted electronically now, billions of dollars flowing around the world continuously. One market closes, a market in Asia opens, then a market in Europe opens, then there's money flowing around the world constantly. But we have this image of a trading floor where people are like using funny hand signals and running back with a piece of paper. But these are the big markets. This is the markets. Does this affect our daily life? In a lot of ways, it doesn't. But does this affect, the big trends in our life? Chicago Board of Trade, futures markets affects agriculture. This carbon is now traded on the Board of Trade. So we can think about that. We have markets for environmental goods and prices for environmental goods we'll talk about later, but we're getting those into these big electronic markets. So we have different visualizations of markets. Let's just think about like what are some fundamental attributes of what a market is. It's somebody buying and somebody selling. It's somebody saying, I will give you this price for this quantity. On the floor of the New York Stock Exchange, when it was guys on telephones, they were like, I'll buy 10,000 at 27. And they're yelling at somebody on another telephone. Okay, I'll sell you. And different people are yelling at each other, coming together. Now it's all electronic. If you ever get a chance to see a Bloomberg terminal, it's a really cool thing. You actually see the trades meeting up and happening. You can visually watch markets happen. A market is also a number of transactions. If there's only 1 or 2 transactions,